including the paper in the program, and thank you for the invitation. It's good to be with you at the conference. So what I'm going to present to you today is crypto wash trading. This is joint work with Xi Li, who's at Newcastle University in the UK, Ke Tang and Yang Yang, who are at Tsinghua University. Okay, and I trust you can all see my slides here. Um, so I don't have to spend too much time motivating why we care about uh, cryptocurrency industry in general. Not to mention the recent price surge of Bitcoin. We might have divergent opinions on that. But the total market cap of cryptocurrencies have peaked in January 2018. I think recently it has even getting very close to that watermark. Um, and the overall transaction volume um, every quarter based on Q1 this past year is about 8.8 US trillion dollars. Now that's bigger than US equity transaction volume in aggregate. Of course, smaller than the currency market, which is very reflective of the fact that crypto tokens are a hybrid of money and investable assets, as I argue in two theoretical papers. And there are over 4,000 cryptocurrencies and all that. But still, this industry is highly unregulated. We've been talking about how we test for ICOs for various token offerings. Nowadays, we have IDOs, initial DEX offering, decentralized exchange offering, so on and so forth. What media articles have pointed out or suspected that is unethical and illegal manipulation in the market include spoofing by bots, pump and dump schemes, and wash trading. And that's what we want to focus on in this paper. What is wash trading? Wash trading is essentially faking volume, right? Buying and selling from the same trader within the market. And what we're going to focus on today is really the wash trading done by primarily exchanges, crypto exchanges. And why do we want to focus on crypto exchanges? They are dominant in the industry. Um, well, they do serve the liquidity and price discovery functions, just like any traditional exchanges. But in crypto, they function as a complex of trading platforms, custodians, banks, and clearing houses. So it's really wielding a lot of market power. We want to understand it better. Second, liquidity begets liquidity. If a exchange has greater liquidity, more agents would come to that exchange to transact. And also, these exchanges, unlike traditional exchanges, are highly unregulated, leaving room for potential manipulation. Okay. In the paper, we asked a few questions. Number one, do crypto exchanges wash trade? And the answer to that is straightforward, yes. But what we found is that only the unregulated ones, which highlights the importance of regulation with potential other legal implications as well. Second question, if so, how severe is the manipulation? We are glad that we are among the very first to estimate the extent of wash trading. And based on our calculation, unregulated exchanges on average fake over 70% of their transactions, which is about 2 trillion US dollars per month, a very significant sum. We also asked the question, which exchanges wash trade under what market environment? It turns out that exchanges with shorter establishment and smaller user base would wash trade more. Cryptocurrencies with high recent returns and low recent volatility would be wash traded more. Countries, financial development level of the country of registration for the exchange, web referral, all those turn out to be not very significant. And finally, what's the impact? Why do we care? Well, we do know wash trading in general could potentially inflate prices. We actually find out that they increase the dispersion prices across exchanges, but the pattern reverses within a week or two. And of course, wash trading could inflate volume. that's going to allow the exchange to be ranked higher. And that's a main piece of incentive for crypto exchanges to Wall Street. Okay, in the interest of time, I'm not going to talk about the literature too much, except to say that we are the first to detect and estimate crypto walls trading as a system-wide phenomena using a few robust statistical and behavioral benchmarks. And we hope to provide evidence for the efficacy or screening function of regulation in the fintech sector, especially in cryptocurrency industry. And finally, the statistical and behavioral principles could potentially be useful for other forensic finance, forensic accounting subjects. Okay. So let me start with the data. We use data, proprietary data from Token Insight that includes transaction histories for 29 exchanges, covering an episode from July 2019 to November 2019. We're going to focus on four cryptocurrencies, Bitcoin, Ether, Ripple, and Litecoin. Other cryptocurrencies are similar. If we look at volume-weighted aggregate numbers, these four will dominate the outcomes in any case. Okay, we have a large number of observations, exchange-related data from official websites, tracking platforms, and so on. We also have ranking data from third-party ranking websites. I've already mentioned we have 29 crypto exchanges. Three of them are regulated if we go according to whether they have BIT license, which is a New York State issued fintech regulation license. We can use alternative criteria. For example, we can go by the Japanese standard or UK standard. The results are similar. Okay, so how do we detect walls trading? The first one, we're going to use three techniques to detect walls trading. The first one is Benford's law. It's basically describing the distribution of the first significant digits in many naturally occurring data. Right? It applies to the heights of mountains, lengths of rivers, sizes of the firms in the economy. And we do find that to be holding for the regulated exchanges. For example, here R2 is one of the regulated crypto exchanges in the middle of blue line, and the dots are what Benford's law would describe as the distribution of first significant digits. But for unregulated ones, here I have UT3 and U8. UT3 means it's unregulated but also ranked relatively high. In the paper, we describe how we divide the sample. It's not going to matter too much. It's just a label because we're going to talk about exchange level walls tradings. We're just going to put them in, classify a group of crypto exchanges that are ranked high as well, one group, tier 1 versus tier 2, which is U8 here. Both of them fail to comply with Benford's law. And that not only holds for Ripple, it also holds for other cryptocurrencies that we look at. Okay, so that's very intuitive. We also conduct a more quantitative test there to show that it's actually quite robust. The second technique we use is rounding. What is rounding? Well, it's a simple behavioral regularity that we are exploiting here. When we place a trade, I don't place a trade of 50, 100, 50,000 to 500, 0.2377789 cents. I don't do that. When we place authentic trades, we tend to round the numbers. That means the transaction distribution should cluster around round numbers. And this has been shown to hold in many settings. Here are at least a few references. We can do t-test of a narrow window around the rounded numbers versus the vicinity area to see if we do have clustering. But for the presentation, I'm just going to show you something really intuitive. Here I'm showing you a regulated exchange. you can see the spikes around round numbers, right, in terms of distribution of transaction sizes. But if we move to unregulated exchanges, firstly, the spikes are not really there, and the shape of the distribution also looks quite irregular. These are all hinting at the fact that unregulated exchanges could be manipulating or faking the reported volume. Okay, and here are some more examples. The third technique we use is basically the tail distribution, power law for describing tail distribution of many, again, naturally occurring data. And theoretically, there is quite some in-depth discussion in Xavier's paper, Xavier and co-authors, why power law would hold. It's basically a fat tail description, right, of the distribution rather than the usual normal assumption. In equity markets, it has been shown that the tail distribution should follow a Pareto-Levy, which is one type of power law distribution with a coefficient in between 1 and 2. And that's something we test here. Again, I'm just going to show you some visual inspections. We have detailed tests in the paper. Now, here we are plotting the tail distribution, transaction size against probability density distribution. If we take the log value, it should, if it's power law, it should fit a straight line. For regulated exchange, which I have here, it roughly fits. For unregulated tier 1, we already start to see some deviation. Now for unregulated tier 2, the lower ranked unregulated exchanges, it becomes even more irregular, as you can tell from these pictures. Okay, of course we have the test statistics to back this up. So in general, we do find very conclusive evidence of Wall trading on these exchanges. We can conduct multiple hypothesis tests. The results are the same. Tier 2 unregulated exchanges fail at least 30% of all the tests, with 10 exchanges failing more than 65% of all the tests. Unregulated exchanges overall fail 40% of tests for each cryptocurrency. So it's not driven by a single type of cryptocurrency pair. Okay, regulated exchanges pass almost all the tests in our data. Okay, that's detection. The detection itself doesn't tell us how much crypto exchanges actually wash trade. So we need to figure out a way to calculate the amount of wash trading. Can we use Benford's law? Can we use power law? Not quite, because Benford's law only describes the first significant digit, whereas power law describes the tail distribution. They are not describing the full distribution. So naturally, we're going to resort or rely on the clustering effect of the rounding phenomenon. The idea is authentic human trees are typically rounded. Authentic algorithmic trees could be unrounded. So there might be some authentic unrounded trees on exchanges. We are going to use the regulated exchanges as well as traditional equity markets as our benchmark. We calculate the ratio. You can view it as calculating the ratio of rounded versus unrounded trees. Using that as a benchmark, plug it into the unregulated exchanges. That's going to allow us to back out the amount of extra unrounded trees on unregulated exchanges. We can put in additional controls so that it's not driven by specific characteristic of the exchanges. What do we find when we carry out this exercise? We can talk about equal weighted average or volume weighted average, but unregulated exchanges, on average, Wall Street over 70% of their reported volume. Even if we put in the controls, it's still over 60%, quite significant. How do we decide which model to use with the control, without the control? How do we select the control variables? We're just going to use the residual arrows because what we care about here is prediction, auto sample accuracy, right? So we're going to select the model, which in this case, we're just going to use the model without the controls. In terms of prediction, that's as good as the models with controls. If we do that, plug it into the unregulated exchanges, what we find is some of them, especially the higher ranked ones, do follow closely as regulated exchanges, right? They wash trade very little, but many others wash trade a lot. Some have over 90% of the reported volume that is faked in general, okay? And if we continue to tier two, it becomes even worse. Another reason why in subsequent analysis, we don't quite use the ones with control is also that for some exchanges, the control variable data are missing. We don't have information on that. But overall, I think I get the message across. It's quite robust whether we have the control or not. Now, we can use a number of alternative measures. I already mentioned Banford's law, right? It's a partial description of the distribution, but it can help us to place a lower bound, right? If I fake all transactions with the leading digits 1 through 9 carefully, I can satisfy Banford's law, but still have a lot of Wall trading, right? So Banford's law in general is capturing some lower bound. So we can use that, and the results are still very significant. We can also use the percentage of tests that a exchange fails or a particular currency, cryptocurrency fails, to have a sense of a certainty of Wall trading. Right? We try so many tests. Which one fails more? These are here's the list of cryptocurrencies as well as crypto exchanges that failed. What percentage of tests do they fail? And regulated ones don't fail any test. Okay. So that's pretty much what we have for detection and quantification of Wall trading. Let's dig a little bit deeper to think about the mechanism or incentives in what we find. If we look at the rank data and if we conduct a counterfactual exercise where we remove the Wall trading and see how these exchanges rank, right? Because the ranks are based on volume. And suppose we put the Wall trading back for a particular exchange. How much does it improve my ranking? So on the horizontal axis, I have the percentage of Wall trading for a particular exchange. And we can see if I fake 70%, it roughly improves my ranking about 46 positions. And that's very important. Why? Because these third-party ranking websites are where people are getting information about the crypto exchanges. If I'm a leading exchange, I believe liquidity there is good. Many people go there to trade. I'm going to go to that crypto exchange, and crypto exchanges charge fees, right, for transactions. That's how they generate revenue. We can also look at what characteristics of the crypto exchange that at least correlates to the amount of Wall trading. It turns out the age of exchange matters a lot. For a recently established exchange, they tend to Wall Street more. For an exchange that has been there for a while, maybe they are already ranked very high or well known, their reputation is at stake. They don't Wall Street as much. Number of unique visitors is a metric for the user base. Right? We can use alternative measures, but it gives a basic idea. If I have a larger user base, the exchange is going to Wall Street less. Other factors don't seem to have too strong an impact in this setting. Okay, so what about a price, a return for cryptocurrencies when we have Wall trading? Well, it turns out that Wall trading does affect return. Right? The dependent variable here is price return in a particular week. We calculate weekly returns, and using weekly closing price and opening price for every trading pair on every exchange. Independent variables are indicators of Wall trading volume, increments of Wall trading volume, so on and so forth. Okay, and what these regressions show us is perhaps it's not best captured here. Maybe it's better captured in the second panel. Is if we take the regulated exchange price as the benchmark and look at the price deviation of the unregulated exchanges that are wash trading, we can calculate the price deviation, and that deviation is correlated with the amount of wash trading we have. Now, if we look at that price deviation, the change in that price deviation, that's actually related more to the previous week's amount of wash trading. Basically, if I have more wash trading the previous week, and this week the price deviation, the difference in price deviation is actually smaller, indicating a reversion of the deviation. Okay, so it's short term, but it does temporarily distort prices in the crypto market. Now, finally, we also discuss a few regulatory implications, as well as implications for practitioners in the space. So wash trading itself is prohibited in many developed markets and known asset classes. We've heard a lot about wash trading through anecdotes, through lawsuit cases, through leaked data for particular exchange, but we just don't have evidence for industry-wide wash trading, and we are here to add to that literature. And I think it's also important that we make a distinction between regulated versus unregulated exchanges. So why would regulated exchange have less wash trading? Well, it's not too hard to imagine that there's a direct regulatory effect. If I'm going through more stringent inspection, I might be careful with reporting my transactions, right, as an exchange. You might argue there could be also a signaling story. I want to signal to investors that I'm a good exchange. That's why I apply for the license. But then after getting the license, there's no reason for me to continue the costly signaling. So, so naturally, I would revert back to wash trading. That's not what we observe in the data. So signaling cannot be explaining the whole story. There could also be a screening story where there are certain exchanges that are very ethical, not engaging in wash trading. There are also the ones that prefer to do things properly. They apply for license and all that. That is fine. That still means regulation provides a screening device. It informs investors which exchanges are more proper, which exchanges are not manipulating their data. Okay, why is this important? Well, the 5 regulated exchanges, we have 3 right in our data, but there are a total of 5 regulated exchanges under New York State's BIT license. Their transaction only represent less than 1% of the total transactions, at least during the window period we have. That means transactions on regulated exchanges is still a tiny fraction of total transactions. And a lot more needs to be done in order to regulate the market. Of course, the usual Lucas critique applies, right? Once we know the detection techniques, exchanges are going to fake volumes while satisfying these rules, right? That's something we can't say too much, but still, in terms of detecting wash trading historically, in terms of deterring wash trading, I think these RegTech tools or statistical tools are useful in that regard. Okay, here at least the example of OKEX is one of the crypto exchanges. It was believed to wash trade a lot. Of course, they argue with industry reports that we don't wash trade. The techniques are not very proper, and I think they have good reasons. The industry reports are somewhat ad hoc. For example, they would assign 50% wash trading, 100% wash trading based on some metric and then just take the average and call that the wash trading amount, right? As you can see, it's going to be quite imprecise. But here, hopefully, I've convinced you that the detection techniques are more rigorous. And in fact, we don't find OKEX to be the one that's wash trading the most. Right? It's actually in the middle. Um, General takeaways. Well, I think it's somewhat shocking that crypto exchanges wash trade so much. You might ask, why do you believe it's exchanges wash trading? Why wouldn't it be traders, individual traders on the exchanges that are wash trading? That's possible. We can't rule it out. But basically, crypto exchanges have a few ways to do wash trading. They can do it directly themselves. They can also introduce incentives for traders, individual traders, to wash trade on their exchange. For example, as an exchange, I can issue my own tokens, and I can introduce reward schemes. If you trade more on my exchange, I'm going to give you more tokens, and tokens are worth some value. In that regard, even individual wash trading could be incentivized by the crypto exchanges. And there are separate studies showing, it's mostly crypto exchanges that are wash trading, not individual investors. That's another distinguishing feature from wash trading in other asset classes, such as equity. Okay? Again, we look at the characteristics that are correlated with the amount of wash trading. We show wash trading helps improve ranking of crypto exchanges. They do inflate prices, at least temporarily, and the statistical tools and behavioral principles should have applications in forensic finance more generally. One implication that I didn't write down here, but is highly relevant for researchers, for econometricians, is that now if we use transaction volume reported from these third-party aggregators and all that, we need to adjust for wash trading to some extent. Otherwise, the computations will be off, right? So if we're doing empirical research on cryptocurrency data, that's something to potentially pay attention to as well. So with that, I'm going to end here. Happy to hear your comments, thoughts, and happy to answer questions as well.